Hi children, I hope you're doing good. Yes, little ones, about to be going out of school in just a few more months. Yeah. So this is your chance to make your future bright. Give it your 100%. Okay. Accounts is easy, bringing to you today the different methods, the two different methods of maintaining partners' capital accounts. There are two methods basically. One is the fixed capital method. As the name suggests, fixed capital, we are not touching, disturbing the capital account for every transaction that happens between the firm and the partner. Because there are a lot of transactions that keep happening, right? Partners are bringing in funds, withdrawing funds, partners are credited their share of profits, losses, debited with their share of losses, and credited with again commission, salary, interest on drawings, again interest on capital, then charge interest on drawings. A lot of things keep happening. So we don't want to disturb the capital account in this case. So capital account is called fixed. Of course, it will change. But when will it change? We will discuss shortly. But it will not change for every transaction that happens. So where are the other transactions supposed to go if not to the capital account? Yes. We open a current account here. Alright. So in this method, we open a current account of partners, in which I will record all these transactions that keep happening throughout the year. For example, interest on capital to be credited. We will not credit to partners' capital. We will credit to the current account. Okay. Similarly, share of profits or losses will be debited to current account instead of capital account. Till now we were doing the fluctuating method where we did not have no current account was there. So everything was being debited and credited to the capital account because we don't have the current account, right? So here that's the method, and that's why it's called fluctuating method, because since every transaction is either increasing or decreasing the capital account balance, the capital account is called fluctuating, right? You got the broader idea, right? Now in this, so how will things change here? Let me take. Now if nothing is mentioned in the sum, you assume of course the partners are maintaining fluctuating capital method. Okay, this is the kind of default setting here. So by default, fluctuating. And when do you do the fixed? If the word fixed capital is mentioned anywhere in the sum, partners maintain fixed capital, or the fixed capitals of the partners are so and so, the word fixed is given clearly, or you are supposed to make the current account of the partners. If they say any such words like this are the hints towards fixed capital method. So you will have to understand like that. If nothing as such is given, that means it is fluctuating capital method. No need of current account here. Alright. So let's take a few examples. We have already done a few entries, adjusting and closing entries. Now let's see how it varies under fixed capital and fluctuating. Sometimes you'll just be asked one question. Okay, give the adjusting entry for interest on capital to partners under fixed capital method. It's specified which capital method. Okay, so what is the adjusting entry? Let's see. Number one. For providing interest on capital. First one. Here in this, of course, interest on capital has to be debited. That is for sure. Interest on capital account debit, but it will be credited not to the capital account. This will be going to partners' current accounts. In fluctuating method, interest on capital account will be debited as here, but it will be credited to partners' capital accounts. That's the difference. The whole difference. If nothing is said, you will say, okay, what is the entry to provide interest on capital? Okay, interest on capital debit to partners' capital, usually. But if you just ask the entry, it's better to write interest on capital debit to partners' capital / current account, because both methods are possible. In case of fixed, it will go to current account. In case of fluctuating, it will go to capital account. So you've given your complete answer there. Let's take one more. Suppose we're talking about interest on loan given to a partner. Okay? Adjusting entry. We're not talking about closing entries. Closing entries will not change. Closing entries will not change, depending on the sum, because closing entries don't involve the capital account or current account at all. What is the closing entry for interest on capital? Tell me. Usually it is PL appropriation to interest on capital. Doesn't make a difference whether I am making the accounts as per the fixed or fluctuating method. Understood? So closing accounts are independent of the method. It's only the adjusting entries that will differ. So interest on loan given to a partner. Interest is an income. I will have to credit interest on loan, right? Interest on loan has to be credited. And I will debit here, in this case, to which account? Current account of partner. And here, partners capital account. There is no current account. There is no question of current account. And interest on loan gets credited. Here, one more last entry to say close profit and loss appropriation account. If it is asked like this, how do you close PL appropriation account divisible profit? Meaning what is the entry you pass to distribute the divisible profit among the partners? If it is specifically mentioned fixed capital, of course it is going to the current account. So PL appropriation. Now children, there is a big difference between PL account and PL appropriation account. Mind you, the council is very particular about journal entries, what you're writing there. If by mistake you forget writing appropriation, you just write PL account, you will not get any marks for this. Yes, you will lose your entire marks for the entry. So please be very careful as to what you're writing in the journal, because I'm sure you don't want to lose marks like that. So this will be going to partners current account. So share of profit goes to partners current account, and here of course this will go to partners capital account. Alright, done. So this is the journal part of it, so I've made it very clear. This is the difference between a fluctuating method to maintain partners capital account or the fixed capital method. So if any queries, you feel free to ask in the comment section. Whatever I've taught in the video, I hope it gets directly right through, all your doubts will be clarified. But in case you still have doubts, please ask. So as far as this distinction is concerned is clear. I'll just show you quickly how these things appear in the partner's capital or current accounts. This is we are doing under fixed capital method, where we have both two accounts, capital and current account. Your partner's capital account will start with your opening balance, meaning 1st of April, whichever year is given. You will write here by balance brought down. Now understand this, everything is important here. By balance brought down, or if your business is beginning this year, meaning partners have started doing business, commenced doing business, something like that is given. You will not write by balance brought down. What will you write? By cash or bank. Okay, so here or I am writing by cash or bank account, because you are starting business. There cannot be obviously any balance brought down. When do we have a balance brought down? If we had something from the previous year to be carried forward to this year, then only we have balance brought down, right? पहले अगर business ही नहीं था तो फिर क्या balance brought down? So if you're starting this year, please write by cash or bank. Otherwise, again you lose marks for this, right? So this is done. So usually you will start with this amount here. Then this is basically if nothing is changing, meaning partner is neither bringing additional capital nor withdrawing more capital. Capital, not the regular drawings. Please, I'm saying withdrawing capital. If he is neither withdrawing capital nor bringing additional capital, nothing changes. You bring down the balance, you carry down the balance. Finished. Okay? So in this side, on 31st March, you will have two balance carried down. The same figure, because nothing has changed. But when does it change? It changes only 2 times at the most. And if at all, something like that is happening only then. Otherwise, it remains fixed. If the partner brings in additional capital, what does the journal entry tell me? Cash or bank account debit to partner's capital. So here, on whichever date he is bringing it, we will write here again by cash or bank for additional capital introduced. Your fixed capital will increase. Okay? So if this is the only thing, 1, 2, 3. Or if he is withdrawing, then you will write here to cash or bank. Please do not write here drawings. Drawings comes into picture for regular drawings, and we are not talking about regular drawings. We are talking about permanent withdrawal. So please write here also withdrawal of capital. So your question, when does partner's fixed capital account balance change? Under which 2 circumstances? Only when partner brings in additional capital, or he withdraws capital from the business, or he makes drawings against capital, whatever is the case. Okay? Please, again I am repeating, this is not regular drawings. You will not write here 2 drawings. No marks for that. Please understand the concept. There is a conceptual difference here. Done with this? So what goes to current account? Your current account can have on the first an opening balance this side, or it can also have on 1st April itself to balance brought down a balance here. Now if the sum says partner's current account balance on 1st of April is 10,000, that's it. By default, you will consider a credit balance. You will write by balance brought down. But if the sum says the partner has a current account balance of 10,000 debit, this debit meaning you will bring down the balance in the debit side. That's simple. So whichever side the balance is given, you bring it down. Partners will get interest on capital to be credited. Whatever the partners are getting from the firm. This is usually on 31st March. Then salary. You will write here by salary. Commission. Share of profit. So that comes from profit and loss. Appropriation account. This is the share of divisible profit. Okay. If partner suppose is getting rent from the firm, then it will come on the credit side of partner's current account. Sometimes your sum will also say apart from interest on capital, interest on current account also. Allow partners an interest of 10% per annum on capital and current account balances. So in that case, interest on current account will depend on whether the partner has a credit balance or a debit balance. If it's only allow, you will just get here interest on current account also. Alright. So here you will have interest on current account credit. If you have, the partner has a credit current account balance. If he has a debit balance, of course he will not be getting interest on it. Why should I give interest on it? He's already overdrawn his current account, right? So, this case mein nahi dena hai. And what will be on the debits? 2 drawings. On the closing date, we will debit to the current account all drawings and close. This will be the journal entry to close drawings account of partner. Drawings account related to regular drawings. So you can also keep a note of it for your understanding. This is for regular drawings and not withdrawal of capital. Withdrawal of capital will not come here, it will go to capital account in this method. Current account will be debited. Journal entry, partners current account debit to drawings. So you close your drawings account. Also interest on drawings will be debited here. If the partner is supposed to be paying interest on loan to the firm, for any loan taken, that will also come to the current account. In the journal also I had shown you this, partner's current account to interest on loan. And in case, the sum says also charge interest on the debit balances of current account. In case it says uses this word charge interest on current account as well on the debit balance. Partner has a debit balance, we will write here interest on current account because this is going to be charged. Charge meaning you reduce the current account balance. Now here you have to very clearly understand that in a particular sum, in a particular account, either this balance will come or this balance will come. Not both. Of course, current account cannot have both a balance brought down here on the credit and the debit, either or. Similarly, this, if it's coming on the credit side, will not come on the debit side. Pretty simple, right? So you have to take care of all of this here. And then we will close the balance of current account. So either it can be a positive balance, like balance carried down here, or it can be a balance carried down on this side as well. Again, either or situation. You can't have a closing balance on both the sides. If your credits are more, you will have this balance. If your debits are more, you will have this balance. Whichever side is falling short, you will put the balancing figure there. So please make a note of it. This is very, very important, children. Fixed and fluctuating capital. Under fluctuating capital, of course, I don't have any current account. So all of this goes to capital. Nothing, no distinction, right? So obviously the regular drawings also will be debited to capital. The withdrawal of capital will also be debited to capital. Of course, there will be nothing like interest on current account in that case because there is no current account. So what interest on current account? Okay. So here this is what it will come to. All of this will be going to partner's capital. So I am not writing and removing this. All of this goes to debit of capital, this goes to the credit of capital. When we merge this, meaning under fluctuating method, there is no current account. Everything goes to capital account. I told you, accounts is easy. Start believing it the way I do. Alright? So keep healthy, stay strong, take care of your health, not just physical health, mental, emotional, all health. Because you're overall, you're not just the physical body there. Be happy, keep yourself motivated, go do some workout. It's time for my workout. See you guys in the next video.